Hey everyone, welcome back to Corporate Decoder, the place where let's just say some companies really know how to spice up their investor relations playbook, and today's report is no exception. Get ready because we're diving deep into a filing that is all about raising money, and by the looks of it, this company is ready to make a big splash. We're talking about a move that could significantly boost their war chest for research and development. Our company today is Akari Therapeutics PLC, which goes by the ticker AKTX. They've just dropped a crucial report, and it is all about a registered direct offering, which sounds fancy, but essentially means they are selling a bunch of their stock, specifically American Depository Shares or ADS, directly to investors. And they are not just selling shares, oh no, they are bundling them up with warrants. Think of warrants like options to buy more stock later at a set price. It is like a 2-for-1 deal, or perhaps a buy now, get the chance to buy more later kind of situation. This is a Form 8K filing, which is like a special announcement to the US Securities and Exchange Commission, or SEC, when something big happens. And this certainly qualifies as big. The date of this report is the 14th of October 2025, and that is also the earliest event reported. This tells us that on this day, things really started cooking. We learned that Akari Therapeutics is incorporated in England and Wales. Their principal executive offices are located in Boston, Massachusetts. Their telephone number, which we probably do not need to call for this report, is 617-758 to 6867. That is not a typo. I am reading the input. It is 92927475510. So it is 92927475510. Important to note, they are not an emerging growth company. It is a simple yes or no checkbox, and they checked no. Let's look at what kind of securities are registered. They have American Depository Shares AKTX trading on the NASDAQ Stock Market LLC, and also ordinary shares par value 0.001 per S-Hair, which are also listed on NASDAQ but not actively traded in the same way as the ADSs. The ADSs are special because each one represents 2,000 ordinary shares. So when you buy an ADS, you are actually getting a piece of 2,000 real shares. This section tells us about a material definitive agreement, which basically means they've signed a really important contract. On the 14th of October 2025, Akari Therapeutics entered into a securities purchase agreement, or rather a purchase agreement, with some institutional investors. This agreement is for the sale of 3125000 American Depository Shares, or ADSs, and as we mentioned, each ADS represents 2,000 ordinary shares. Now this is where it gets interesting for the investors participating. The combined purchase price for each ADS and its accompanying warrants is just $0.8. That's a very low price point. The total gross proceeds from this offering are expected to be around $2.5 million. This is before any money they might get from investors exercising those warrants later on. The deal is expected to wrap up around the 16th of October 2025. So what is the plan for this new cash? The company says it is for working capital, general corporate purposes, and crucially for continued research and development, or R&D. They specifically want to use these funds to highlight the unique action of their novel ADC payload against cancer, building on new data they will present at a big cancer conference in early November. This shows a clear focus on advancing their drug development pipeline. Now let's talk about these warrants because they are a key part of the deal. There are two types, Series E warrants and Series F warrants. The Series E warrants have an exercise price of $0.98 per S-Hair. They become exercisable after shareholder approval for issuing the shares from the warrants, and they have a 5-year term from that approval date. The Series F warrants also have an exercise price of $0.98, but they are exercisable immediately on the shareholder approval date and have a shorter term of 30 months from that approval date. What's interesting is that if there isn't an active registration statement for the shares when someone wants to exercise these warrants, they can do it on a cashless basis. This means they can essentially trade the warrant for the shares without actually paying cash. The company has also committed to filing a registration statement to allow these shares to be resolved within 30 days of the closing date. Getting shareholder approval is a big hurdle for this deal. The company has to call a special meeting within 60 days of the closing date to get this approval. If they don't get it, they have to keep calling meetings every 40 days until they do, or until the warrants no longer exist. This commitment to pursuing shareholder approval highlights how important this funding is for their operations. There is also a beneficial ownership limitation on these warrants. This means a warrant holder can exercise their warrants if doing so would put their ownership of ordinary shares above 4.99% or 9.99% of the total outstanding shares. This is a common feature designed to prevent a single investor from gaining too much control through warrant exercises. Following the closing of the offering, the company has agreed to a cool-down period of 30 days. During this time, they enter into any new agreements to issue or announce the issuance of any new shares or similar instruments. They also can file any new registration statements. Additionally, for a full year after the closing, the company is restricted from entering into what they call a variable rate transaction, which is defined in the agreement to prevent dilution of their stock. The purchase agreement itself contains standard clauses for representations, warranties, and indemnification. There is also a placement agent agreement with Ladenburg Thalmann and Company Inc. They acted as the exclusive placement agent for this offering. Akari Therapeutics is paying the placement agent a fee of 7.2% of the gross proceeds, a 0.5% management fee, and a non-accountable expense allowance of up to $75,000. The placement agent will also receive their own warrants called placement agent warrants, which will be similar to the Series E warrants for an amount equal to 4.0% of the ADSs sold, meaning warrants for up to 125,000 ADSs at an exercise price of $1. These have a 5-year term from the start of sales. The ADSs being issued are being offered under a prospectus supplement filed with the SEC. This is part of a shelf registration statement that became effective earlier in 2025. This allows the company to offer and sell securities off of an existing registration statement without having to file a new one each time, which speeds things up considerably. Now, here is a crucial detail: the warrants, the placement agent warrants, and the underlying ADSs and ordinary shares are being offered and sold under an exemption from registration rules. This means they are not being registered with the SEC, in the same way public offerings usually are. This is typically done for sales to what are called accredited investors or qualified institutional buyers. These investors have represented that they are sophisticated financially and are buying these securities for their own accounts, not for immediate resale to the public. The offering was made without any general solicitation or advertising. This is important because it means these securities cannot be offered or sold in the US, unless they are registered or an exemption applies. This is a standard disclaimer saying that this report itself isn't an offer to sell securities, and that they won't be sold where it would be against the law before proper registration or qualification. They are also telling us that the details provided here are just summaries, and the full agreements, which are filed as exhibits, are the definitive documents. This refers to an exhibit which is a legal opinion from a law firm about the legality of the shares being issued. It is a common practice for comfort and due diligence. They also mentioned that this offering was announced in a press release on the 15th of October 2025. This means that the news broke just after the agreement was made. Finally, we have the signatures. This report is signed by Torsten Hombeck, who holds the title of Chief Financial Officer on the 16th of October 2025. This is a common endorsement from the company Top Financial Executive. This section, unregistered sales of equity securities, basically points back to the details under item 1.01. It reiterates that the warrants and the securities related to them are being issued without traditional registration, relying on exemptions. And as with almost all filings, there is a section on forward-looking statements. This is a legal disclaimer. They're telling you that statements about future expectations, like when the offering will close, are just predictions. They are not guaranteed to happen, and things beyond their control could affect the outcome. So, don't put all your trust in these future predictions. They also state they have no obligation to update these statements if things change after the report is filed. This section is about exhibits. It lists all the supporting documents included with the filing. Here we see a list of exhibits including the legal opinion on the ordinary shares, the form of the securities purchase agreement, the form of the placement agent agreement, and forms of all the warrants being issued. There is also an exhibit 104, which is the cover page interactive data file, typically used for SEC filings. Now, looking at this whole situation, what does it all mean for Akari Therapeutics? They are clearly in need of significant capital, and they secured about $2.5 million in a registered direct offering. The price point of $0.8 per ADS plus warrants is very low, suggesting either investor confidence was shaky and they needed to offer a very attractive deal, or that the market conditions were just right for this kind of discounted offering. The company's strategy relies heavily on advancing its R&D, particularly the ADC payload, which is aimed at cancer. The fact that they have to secure shareholder approval for issuing shares from warrants, and that they might have to hold multiple shareholder meetings to get it, shows a dependency on external validation for future share issuances. The key risk here is obtaining that shareholder approval. If they don't get it, it could significantly impact their ability to leverage these warrants in the future, potentially limiting their capital raising flexibility. On the other hand, if their R&D progresses well and they present compelling data at that cancer conference, it could boost investor confidence, leading to the exercise of warrants at a profit for the investors and more capital for Akari. In essence, Akari Therapeutics is raising a modest sum of money at a significant discount to fuel its drug development pipeline. The success of this strategy hinges on both the scientific validation of their technology and their ability to navigate shareholder approvals for future share issuances. It is a high-stakes play, betting on science to drive future value. Alright, that is our breakdown of Akari Therapeutics' latest filing. What is your take on these numbers and what they signal for the company's future? Do you think they can achieve shareholder approval and advance their R&D? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord community linked in the description for more discussions. Thanks for watching. See you next time.